welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Private Lenders Podcast. Chris and Jason here. Thank you for checking out the show. Quick announcement. We are going to be doing a 2-day virtual boot camp in September. We haven't picked the exact dates yet. It's going to be for a max of 3 lenders. It's going to be 2 full days. There's a lot of stuff that we cover, basically the entire game plan A to Z. To learn more, go to hardmoneymastermind.com, click on consulting, schedule a time to talk to Dave, and he'll walk you through the details. All right, we've been doing some creative lending recently. And on one hand, we're always doing creative deals because we can and we know how to structure them and we control our capital and all of that. But at the same time, I feel like when the market gets a little shaky, things get a little uncertain, both in the real estate market and the lending market, more creative deals start coming out of the woodwork. Would you agree with that historically?
Yeah, because there's a limited amount of liquidity, and a lot of the traditional capital sources might not be messing with that. We've seen it a bunch of times. One thing to note about the private lending sector and the hard money lending sector, and I was talking to somebody about this the other day in the Mastermind group because they're trying to scale their business and they're having some challenges, is we're in a really good position because we can pivot to different asset types and lending structures inside the private lending space. Now, what do I mean by that? This particular lender, all he was ever doing was fix and flip stuff. And he was in a market and he was having a hard time scaling and getting to the size that he wanted to be. And I was like, dude, you don't just have to do fix and flip stuff. A lot of the stuff that we do is bridge loans on free and clear rental properties, right? Sometimes rental property owners don't necessarily either qualify for or want a DSCR loan. They might have a $200,000 rental property, free and clear, and they need $60,000 to help them buy another property or $100,000 to inject in their business or do something or renovate this rental property to get it ready for market, whatever the case is. Commercial loans, the same situation, right? Small balance commercial loans are hard to get. It is hard to go to a bank and get a small balance commercial loan. It just is. And there's a lot of opportunities out there, and they're qualified borrowers. They're not expecting the highest leverage. It's potentially in a good spot to do that. And on those deals, we're at 50 LTV. Now, keep in mind, when we talk about the structures and the deals, there's typically always a number that works. I'm not talking about giving somebody 100% financing. I'm not talking about like high leverage on these things. We do up to 50% on small balance commercial. On the fix and flip stuff, we're doing minimum down payment is 20%. When you include closing costs and things like that, it ends up being 25-30% skin in the deal. And refinances on rental properties typically will do up to like 60%. Now, this is when I say up to, that's if everything else is perfect. Good credit, financials, they know what they're doing, clear exit strategy, everything else checks out. It's an easy property to comp. So don't just think you're stuck in this one asset class. Now, I'm not saying jump into commercial stuff if you're not comfortable with it and if you're not ready for it, but just keep in mind that we're all good in the private lending side, because if one side of the business has challenges, we're good, right? You can pivot to these other asset classes. We've been competing with institutional backed lenders ever since they came out. It never slowed down our production. We might not have got the fix and flip volume that we would have liked, but we were able to do other types of asset classes.
Another thing that I've noticed recently in the past, we've had a pretty solid past few months in terms of loan production. Second quarter was good, and then moving past that into July, really solid too. Which is great because things were a little slow in the first quarter, a little shaky. I have noticed recently that we have done some lower credit borrowers than we normally do. In terms of fix and flip stuff, our average credit score is what? Like low 7, something like that. Like it's higher than one might think.
Well, it depends. The high leverage stuff, 20% down, yeah. But like we've certainly done lower credit score borrowers when they're bringing 50% cash into the deal. No question.
Yeah, and I've noticed a few recently where we're at low LTVs and they happen to have a good amount of cash. Now, why someone might have bad credit, low credit scores, and like unpaid bills, yet they have a few $100,000 in cash, why that's the case, I couldn't tell you. I can't explain certain people's behavior when it comes to paying their bills. It's always been confusing to me. Like if you have, 250 in the bank, like why aren't you, paying everything perfectly on time? Anyway, it's a conversation for another day. But I've noticed that we've had a few of those recently where it's like maybe a refinance and construction situation, right? So they own a property, it's not yet complete. It's worth, 250 right now. Once they finish it, it'll be worth 400. They've been doing this out of pocket or maybe with like a small private loan on it in essence of the construction completion loan. So we'll come in, we're at a low LTV to begin with, we're at even lower LTV when they're finished. It's all good. They're going to sell it when it's done. And the credit score is definitely preventing them from getting money from an institutional, right? Like they have minimums because they're basically banks. Yet the whole deal makes sense. The whole deal adds up, and there's compensating factors, a term that's been thrown around in the lending industry forever. Like, just like I said before, like if you have 550 credit, but you have 250K in the bank, compensating factor, right? Like that's a calculated risk in terms of going and funding that deal. So that's something that's a little creative, a little unusual for us, but total deals that I've been seeing more of in the past like couple months, I'd say.
And no competition is going to touch that deal. Now, keep in mind, you got to take all these things for what they're worth. I'm not saying go all in on one particular structure, but if a borrower has low credit and they're buying a property to fix and flip and resell, they have an exit strategy. If they have low credit and they're contingent on some sort of refinance, they don't have an exit strategy.
That's not
right?
happening.
So you got to take that into consideration. That doesn't work on somebody who's going to refinance the property. That's going to work potentially if they're experienced real estate investor and they're flipping the house. Then that potentially works. So that's what a lot of those are. But like we've done plenty of loans where the borrower has lower credit, 600 credit, but they're buying a property for 250, it needs 50 in work, and we give them a loan of whatever, 150, 175, 50 held back, and in essence they're bringing more cash to the table than we're bringing. They got a lot to lose. They're not going to walk away from it, but like they're not going to just refinance this property. They know that. Hopefully they know that. We know that, and we'll have that conversation with them that as long as the plan is to sell, and you can't force their hand and make them sell, but cash is king, right? If they have enough skin in the deal, they're not gonna walk away from it, right? They're gonna do whatever they can to get as much money of that back too, if they end up defaulting. So let's talk about a few deals recently that have come across our plate. We've closed on some of these already, some we haven't, but we do a Monday huddle up with our entire team every Monday morning, short 20 minutes, 30 minutes. And I was explaining to them some of the deal flow that we've been seeing across our desks, and they agreed that it was similar. And this will happen. This will happen as the markets shift and there's less liquidity out there. It's not even less liquidity. It's they want certain types of structures. And these are one-off deals, right? These are one-off deals. Like you can, if you're Kiavi and you want to deploy billions of dollars and you have to do, all 60 loans for the one real estate investor who does 60 loans a year, right? Like that's not this model, right? You can still have a big portfolio with doing kind of, these deals for these one-off situations as needed. So like, I got a call today from a real estate investor that we did a loan for. He fixed up a property maybe like 6 years ago. He bought it, fixed it up, put a tenant in there, paid it off in cash. He owns a bunch of 7-Elevens around town and some other assets and things like that. And he was able to, to pay it off in other means. He reached out and he's like, hey, I need, I'm looking to buy another business. I need 150 grand on this deal. Well, we lent him 200 at, a few years ago. So now he needs 150 for this thing. This is actually going to be our third or fourth deal in the same asset. I feel like every few years he'll reach out, kind of try to tap the equity for the particular project, which is fine. I'm happy to. Now, because like we're not going to do the highest LTV. He's got good credit and stuff like that, but we're not going to do the highest leverage for him because his exit strategy is not, fix up the property and sell, right? His exit strategy is, hey, I'm going to pay you off by other means. Well, at the right LTV, that's a reasonable thing, right? At a 65 LTV, probably don't want to do that. At a 50 LTV, cool. He'll figure it out. He's going to sell a business. He's going to pay it off in cash. He'll figure out a way to get a refinance if he needs to, right? He's a qualified person. He'll do the means. Now, you might say like, well, why doesn't he go to the bank? I mean, he might be able to go to the bank, but like that's going to be a hassle. They're going to look at his business and his personal tax returns. They're going to figure out, oh, what are you using the money for to do this and this and this? Let me see your last 3 bank statements. His email to me today was, Jason, I got to get this thing closed by next week. Can you do it? And he CC'd the title company. I responded in essence, was like, because we've done a few deals for him. Normally I'd get on the phone with them immediately, but we've done a few deals for him in the past. And I know the title company as well. And I said, hey, when can title get in? They're like, we'll get it into you Friday or Monday. So next, Tuesday, Wednesday, no problem closing. Cool. Close in a week. Easy situation, right? Another interesting one that we're working on is, and this is actually interesting. I got 2 deals exactly like this last week. Neither one have committed to proceed yet, but I have a feeling we'll probably do both of them because I know they're not going to have many options, and they were okay with our terms. It's just a matter of kind of putting everything together. They were nonprofits, and they reached out because they had free and clear rental properties in high value areas, and they needed. They were both selling. They're nonprofit, had nothing to do with real estate, but they owned real estate as well, and they were generating income. And these properties were worth hundreds of thousands of dollars a piece. Probably like one of them had 2 properties that were worth $1 million. We were going to do a loan of $300 on that. The other one had like a $400,000 property. We we're going to do $100,000 on that. And they're nonprofits, and in essence, they're rental properties. They need money to finish up the rental property. There's turnovers to renovate the rental property, and then they could sell it for top dollar in the market. They both wanted to do that. They're both nonprofits. I tried to get them both to guarantee. We haven't fully flushed that out, but chances are there's going to be no guarantee involved on it. It'll be non-recourse loans. They're both, sub 40 LTV. So it's not really a problem on that. And the reason why the non-recourse, number one, it's a low enough LTV. And also, there's a question mark if a nonprofit can even guarantee it, because the person who's signing and guaranteeing doesn't necessarily have an equitable interest in the property anyways. It's the nonprofit that does. So either way, I'm going to try to get them a guarantee if we can. Point being is they need to tap quick cash, and they have equity in these properties, and they have the means to execute on them. We're at low LTVs. They're good areas. Deals like this will come up as it's hard to get capital. I remember seeing this years ago when we were in a similar spot in the market. So the purpose is look out for opportunities like this. Be opportunistic. Ask the right questions. Go through the 4 C's. Collateral being the most important. Just because someone has great collateral doesn't mean that you can necessarily move forward and do the deal, right? Because collateral is the most important thing, and I get it. But even at a 40 LTV deal, if you're dealing with, somebody who's just not sophisticated or can't handle the project, we've done plenty of them sub 40 LTV deals that have defaulted. They just have, because they weren't sophisticated enough to execute on it. So do they have good character? And then, do they have good capacity, right? Do they have the ability to have an exit strategy? Do they have a real game plan in place to pay you off? Because again, Chris talked about this earlier in the episode related to, we've been doing some deals with lower credit borrowers. For the most part, we don't have a credit requirement. We don't have a lot of different requirements, but you have to look at the whole picture. If you have lower credit, but you have a lot of cash in the bank, or you have low credit, but you bought this property for, $400,000 and it's free and clear and you only need 100. And we believe that you have the means to do so, it could work. Now, if you have no credit, if you have bad credit, you have no cash, you don't have a good deal, you're not going to get a loan. That's just the case. We turned down a deal recently that the borrower inherited the property is worth $300,000. So they have no skin in the deal, and they want to do a construction budget where they think it's 150, but it's huge. It's a huge project. So chances are they need significantly more than that. And we're like, yeah, it would probably be like 200 minus 200, right? And I was like, yeah, we're not comfortable doing that. Maybe what we would do is like 100 with $100,000 holdback, and you have to bring like $60,000 to the table and then get the project to a certain place. And then our construction holdback comes back. And I know that's confusing for people to think, but in essence, we would do a 0 day one funded loan, and then we'd have $100,000 in construction holdback. They do the first $60,000 out of pocket. After they put in $60,000 of their own money, then we come in and we start drawing out. And in essence, we're going to be at a 33 LTV deal the whole time. And it potentially could work because we're eliminating a lot of risk, because they're putting cash out of pocket to get through a good chunk of the construction. Point being, is a creative deal.
Oh, also one other one real quick before we hop. Do you want to give a breakdown of the terms you put out on that small commercial auto shop in Montgomery County from last week? You had a conversation with the broker, put out verbal terms. We haven't locked that one up yet, but it's a good chance it could happen. And also I think there's some context to why we quote this way.
Yeah. So and add in if I'm forgetting something, but in essence, a broker reached out, said he had a very qualified borrower who was in the auto industry and he was trying to create his own body shop. And he bought a decent piece of real estate that was probably priced somewhat accordingly. It's kind of a funky one because when it was inherited and it was inherited and then the seller's heirs were disposing of it. So like, who knows not that they're motivated, but it's going to be hard to do a creative transaction with that. And anyways, pretty much they were like, cool, we kind of got to close quick. What can you do? And I was like, I don't know what we can do, but a good start is, can they put down 50%? And they're like, well, they have a bunch of, free and clear assets. The brother lives in one, they live in one. I was like, yeah, I don't really want to mess with any consumer deals. They didn't have much equity in a rental property. And so in essence, we tried to get creative and I was like, listen, the guy has some money, hundreds of thousands of dollars, not millions of dollars. I was like, see if we can figure out a way to work a capital stack for this guy. And I'm telling the broker this at this point, maybe the borrower puts up a few $100,000. Maybe he tries to raise a few $100,000 from some friends and family that'd be willing to give him some money. And maybe you get the seller to put up, a few $100,000 and carry paper. And maybe between the two of them, we can work out a deal where he's buying it for 2. We come in at like 800 to $1 million. He brings in 1.2. We bring in $1 million, something like that, and see if we can get creative to do a deal like that. So we didn't get real far down. I don't need to go too far down the road of this, of like, well, what would you do here? What would you do here? It's like, listen, let's start with this. Let's see if you can come up with the down payment. That's the first step. These are going to be the estimate terms. Try to come down with the down payment. This is going to be the estimate timeline. We talked about environmental issues. I was like, it is potentially an ex-mechanic shop, so there might be some environmental issues. So this would be the cost and the timeline to get some of those things ordered. Anything else I'm missing on that?
No, that's the idea. It's just an acquisition-only loan on small balance commercial here, like very much in our home market, actually not too far away from where we grow up. Point being is that we're getting a lot of interesting deals, a lot of interesting looks, and putting out common sense quotes. A lot of them won't hit, good amount of them will, and we're definitely taking advantage of a change in market, right? Like I'm seeing a lot more stuff, kind of about the residential market being, soft in certain areas and things changing a bit. I've heard mixed stuff on commercial. Actually, commercial kind of popped back up unexpectedly, but we'll leave that for another podcast. But point being, be opportunistic, be smart, be safe, profitable. I hope you guys are doing really good loans out there. And I hope to see everyone inside hardmoneymastermind.com and here next time on the podcast. Have a good one.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.